Welcome to the Prudent Pulse. We're covering the week of May 5th to the 9th. Now, the S&P 500 is coming off a 9-day win streak, which is the longest since November 2004. And Friday's non-farm payrolls came in better than expected for April, and that's signaling real economic data largely remains intact for now. One notable exception, though: initial weekly jobless claims surged to a 2-month high, and that's perhaps an indication of early economic trouble that needs to be monitored. Now, in terms of corporate earnings, 3/4 of S&P 500 companies have reported, and the results have been strong. Earnings growth is pacing 12.8% ahead of last year, which is even higher than what was expected coming into 2025. That being said, though, there are concerns that demand was pulled forward into Q1 ahead of the tariffs, which would detract from future quarters' performance. Full-year earnings expectations have been reduced from 14.8% at the start of the year to just 9.5% currently. Now, it's no surprise that many companies have been less forthcoming with guidance due to continued uncertainty around trade. And this morning, Treasury Secretary Scott Bessent says that he expects trade deals to be announced as early as this week and expects significant progress with China over the next few weeks. Now, while U.S. economic data has been resilient thus far, the economic picture in China is less clear. According to a Wall Street Journal article over the weekend, the Chinese government has stopped reporting hundreds of data points, including land sales, foreign investment, and unemployment figures, which makes it harder to understand China's economic health. One thing is clear, though: the curbed U.S. demand is compelling Chinese companies to redirect sales into the domestic market, which is stoking fears of deflation there. And Goldman Sachs expects China's consumer price index to fall to just 0%, and their producer price index to decline a further 1.6%, even after a 2.2% drop last year. And that's this week's Prudent Pulse.